Welcome back to another episode of the Money Cog, where we discuss stocks which we cover in our premium notes, which can be found on the website, which is in the description below, but it's www.themoneycog.com. Now, if you like the content that we provide, we give us a thumbs up and like this particular video, and also subscribe to our channel, where we can write or we can produce more content like this, which will hopefully get you guys to come up with new ideas or give you ideas of potential investment opportunities, which we think here at the Money Cog has 10x to 100x returns. So today we have the lead analyst, Zaven, with us again today. Nice to see you.
Thanks for having me again.
No problem. Well, today we're looking at a stock you wrote last week for our premium subscribers called Masimo. Is that the right way to pronounce it?
That's
Masimo
correct,
Corp.
yeah.
So why don't you give us a bit of a description of how the business, what the business does, and how does it make money?
Okay, so Masimo is a medical devices business, specifically focusing on non-invasive patient monitoring. The core of their revenue comes from essentially selling devices to hospitals, which uses its signal extraction technology, which is SET. And these are, if we talk about the general bulk of their sales, it comes from simple devices that sit on your end of your finger. This is a form of pulse oximetry. And it's just tracking oxygen levels in your blood, but instead of using the traditional methods, you can also track it, stuff like carbon monoxide levels, hemoglobin, and even respiratory cycles, and all this information that's important to keeping patients alive. During COVID-19, which is still ongoing today, the pandemic, oxygen saturation levels is obviously one of the easiest ways to detect whether or not someone's infected. And with severe cases, this technology has proven to be essential when dealing with patients in hospitals. Beyond blood monitoring and oxygen levels, the group has also started to develop additional monitoring solutions, again, non-invasive. So they have a system for monitoring brain functionality during surgery, and another one for neuromodulation, which is a way of getting people off reducing the symptoms of opioid withdrawal. Now, on top of that, the third and final sort of piece of the puzzle is for coming up with different technologies to automate systems for hospitals. So if a patient is being monitored using one of Masimo's devices, it can all be interconnected into a server. And then if something goes wrong, an automatic signal and alert can be sent to medical staff to make sure that patient gets the necessary attention.
Okay, that makes it's I think for some of our users, it might be a bit sort of not users.
It is a bit of a technical one, yeah.
Yeah, it's quite a technical company for some of the people that might be watching this video. But why don't you go a bit more into the details? Maybe this is where people can understand as well. How does it make money based on what it does? What are the different channels it might be using?
Okay, so the core principle is to manufacture these devices and then sell them specifically to medical facilities, usually hospitals or health clinics. But it has four ways of doing that. The first is something called a deferred equipment agreement. And this is essentially where Masimo gives the monitoring devices at no upfront cost to the hospitals. So it gets their technology inside medical facilities. But in exchange, these hospitals come into this deferred equipment agreement where they commit to spending, they commit to buying consumable products from Masimo that work in conjunction with these devices, for example, a sensor. And these contracts typically last between 3 to 6 years. And the idea is over the long term, Masimo will make the money back they would have made from a direct sale of that device through the sale of these consumable products, effectively becoming a razor and blade model.
Yeah, maybe if you
that's the first channel.
If you sort of explain that a bit more. So you sort of said a razor and blade. What do you mean by that? Is it a bit like, well, so for those, probably a good example is if you buy a razor in the supermarket, you need the blades. And if you're Gillette, you're constantly selling the blades, aren't you, as a recurring revenue? So it's a bit like these guys give the equipment for free, and then they get the back end of the recurring revenue.
Yeah.
So is it like a recurring revenue model for the deferred?
Effectively, it becomes one, yeah. Because even though they're giving away the equipment for free, that equipment requires some form of consumable accessory.
Okay.
For their pulse oximetries, the stuff that sits on your finger, you can use reusable ones, but they tend to be less accurate. So Masimo do offer that, but they offer a more accurate version, which requires you to buy new sensors each time for each use.
Yeah. Okay.
So that's the first sales channel. There's 4 in total. The second one is a direct sale to hospitals. But instead of actually going to each individual hospital around the world, it goes to something called a group purchasing organization. This predominantly exists within the US. And essentially it acts as a bit of a middleman, but it allows hospitals to essentially group together and get the equivalent of collective bargaining. Because they're buying all these medical devices and equipment in bulk from a variety of different companies, it allows them to essentially negotiate a better price. So in fact, Masimo is selling to the hospitals, but it's going through these group purchasing organizations to do it. At the moment, the company has signed contracts with 5 of the largest in the US, and that currently represents 52% of the revenue stream. Now, that actually presents a bit of a problem, potentially, because if it, for some reason, this falls out with one of these organizations, a large chunk of the revenue could become compromised. We'll see. I mean, so far, they haven't had any issue with that, but that's always going to be a risk that exists, especially when they have that level of exposure.
You mentioned a heavy focus in the US. What do you see as what is the revenue mix outside of the US? Because you mentioned that they have relationships with the 5 largest GPOs in the US, but does that count for most of the revenue? What's the sort of revenue mix?
So overall, the US generates around 2/3 of the revenue stream. So it is a pretty significant chunk, but the rest is coming from places like Europe and Asia and Middle East, as well as Africa in some cases.
Okay. So it's fairly, so it's sort of 2/3 US and a good mix. But I guess when it comes down to probably for a medical company, you would want the US is probably a big market when it comes to sort of being able to sell medical equipment within the US. It's probably quite a lucrative revenue stream for them. And maybe globally,
it's where the company was founded initially, so it makes sense that's going to be the largest proportion. But seeing international expansion is obviously promising because there's more opportunities. That does open the risk of foreign exchange rates and the fluctuations that come with it. But in most cases, that's a reasonable price to pay for accessing the global medical devices industry, which is significantly larger than what's just in the US.
So you mentioned in the notes we had a look a bit more, it's a medical company, but it manufactures these medical devices. So you'd imagine that a large aspect of the costs would go into COGS, which is cost of goods sold. So the actual sort of making of these devices. But then you've also got R&D, which you mentioned. And I always thought when you're looking at medical companies or healthcare companies, you want to have a big component of R&D expense. Is that right? Am I sort of misunderstanding it here? And how important is research and development for them?
When it comes to a company which is fundamentally fueled by technology, research and development is a very important aspect. You've got to keep innovating because they're certainly not the only player in this space. You have larger medical businesses which already have the resources necessary to get through FDA approvals. Their pockets are deeper. So, at the moment, Masimo is protected by its sort of patent technology barrier, whatever you want to call it. But if a competitor can come up with a better device, then that's completely irrelevant. Like, why would you buy Masimo if there's a better alternative out there? So when it comes to R&D, it is vital. Luckily, when you compare the research and development expenses as a proportion of revenue, it's actually been growing. So in 2017, it was about 8% of the revenue stream. Today, it's closer to 11%. So the company is increasing their cash flows being dedicated to research and development now. There's no guarantee that will result in a new product which is more innovative or improvements to existing ones, but it opens up that possibility. So it's encouraging to see management commit increased resources to that sort of expense stream.
Yeah, no, it makes sense actually. You always look at that. I think when we look at business of the Money Cog, one is maybe we can even discuss this is you want businesses which have positive free cash flow eventually, or the growth of that. But you also want to know what management is spending that cash on. Is it giving it back to investors through dividends? Is it giving it through share buybacks? Is it reinvesting into sort of R&D or new opportunities, right, where you can potentially grow new revenue streams? So it's always worthwhile knowing where money is being spent. And if it's not generating free cash flow, then it needs to obviously raise that cash externally. the equity or the debt markets. So that's good. And I think sort of leading to that is it gives a reflection of the stock price, really, when you're looking at businesses which have cash flow, and we can go into that later on. But how has this stock performed then in the last sort of 10 years? It seems like it's been around for a while, given the nature of what it does. So it's been around for since 1989, I believe.
Yeah,
Is that right?
it's been around for a while. It was originally founded sort of like a garage startup almost. Just quickly before diving into the share price performance, the last two sales channels includes indirect sales to distributors and then circuit board sales to OEM manufacturers. And that's essentially where other companies want to integrate Masimo's technology in their own devices.
Okay.
Usually, I think two of the top tier customers in that department is Philips and General Electric, but their medical branch. In terms of the stock performance, it has been nearly a 10 bag over the last 10 years. The stock price is up 930%. Now that's measured until the end of 2021. So far this year, if you bought it at that time, you are probably disappointed because the share price has actually dropped by around 50%. Now, when you see half the valuation being wiped out in the space of 3 months, that can be quite a cause for concern at the moment. Obviously, we've got increased market volatility with all the stuff going on worldwide. But in the case of Masimo, the drop doesn't really seem to be caused by underlying fundamentals, but rather a strange acquisition that was announced by management. So I think it was February this year, might have been slightly sooner, the company came out and said it had signed a $1 billion merger agreement with the parent company of Sound United. Now, for those who don't know, Sound United is an audio business. They make their money from selling speakers. So you can, it's quite easy to be a bit confused. I mean,
yeah, I was going to say,
it's not like what does a medical device company have to do with selling speakers? And a lot of this share price drop. When an acquisition is announced, especially large ones, you always tend to see the acquiring firm, the share price comes down because they're about to dedicate capital. I think the drop has been exacerbated by the fact that this is such an odd deal. But the CEO recently came out and he tried justifying this deal. And essentially what they want to do is they want to integrate their medical device monitoring devices with the wireless software platform that Sound United has developed called Denon HEOS.
Okay.
And the idea is that in the long term, it would allow doctors in their offices at the hospital to continue monitoring patients while they are at home. So even after someone has been discharged, you can keep an eye on them. And then if something goes wrong, the medical services can automatically be called. You can have medical staff go along, go home, make sure everything's going hunky-dory. Now that to me sounds promising. We've seen that sometimes in sort of science fiction films. I think it's definitely sort of the future of medicine. But is that worth $1 billion as opposed to just developing it in-house? This is where it's a bit odd. Now, in my opinion, I can only draw one of two conclusions here. Either the company wanted to integrate the system fast. They didn't want to spend years researching, developing it, and all that nonsense. If that wasn't the case, then I think there may be some form of patent blocking them from developing the system, which is held by Sound United. Hence why they decided to commit to an acquisition rather than doing it in-house. Which one it is, I have no idea. We're going to see whether or not this was a smart move when the company releases their next set of results in the future. But for the moment, it definitely is a bit of an odd one.
Yeah, I think it's one of those things where acquisitions seem a bit sort of strange, and you think companies have overpaid for them. But I think a really good example of one that was successful was when Disney sort of acquired Marvel, or Disney acquired I think it was Lucasfilms. I mean, these were sort of very good acquisitions where they've made a lot more in just in the merchandise sales, because they bought franchises and brands. And sometimes it's harder to see, but you can connect the dots. And I think you mentioned it sort of, we can sort of talk about it a bit more sort of later on, but just going back into, it's obviously taken a hit. I mean, but what's the revenue done over that period?
Revenue over the years has been growing on average by 11% odd. Annually, that is. Now, that's not the highest growth rate in the world, especially with some other medical device companies out there. But what's impressive is the company has been doing this pretty consistently. You can see from the chart here, in fact, that every single year it's just been going up, 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 and it just keeps going. Now, this seems to be primarily driven by the fact that more hospitals are starting to adopt its technology. It's managed to harbor itself a bit of pricing power as well, and reputation. And now that it's expanding internationally with more hospitals looking to upgrade, especially with COVID-19 demonstrating the ill-equipped nature of some of these medical facilities.
And I think one of the things which people need to understand is that, when we're writing these notes, we try to give a quick synopsis and we always focus on, and we've always started this conversation on how the business makes money. And the great thing about this and what Zaven was talking about, which is that sort of element of what we were saying was recurring revenue, or that agreement that we were talking about, where once they're in, or once they've got the GPOs on board, it's kind of sticky money, isn't it, really? Because everyone's bought into it. And when a hospital buys into a product, it's like a device, I think it's quite hard for them, especially their procurement departments, to go and change another product. I'm sure it's very difficult, and there's a lot of things that need to happen for them to say, actually, we'll now use this device. I'm sure it's a very long-winded process. And so once you're in, and hence why they're able to probably grow at a steady rate.
Yeah.
Okay. I guess the next sort of question is really around, we mentioned it before, it seems to be a cash generative business. From your opinion, do you think it's using its cash wisely, sort of free cash flow?
So we've already discussed that there's a growing contributions being made towards research and development, but beyond the standard expenses, such as cost of goods sold for their manufacturing side of things, the company doesn't really spend its cash that much. It likes to let it build up over time. I think at the moment there's around 700 million odd dollars in cash and equivalents on their balance sheet, which is pretty substantial. That's from 2021, so it's going to be impacted from the acquisition that's we just talked about. But obviously that's quite a big bulk of cash, and it seems that by retaining a large lump of sort of liquidity on the financial statements, it provides a lot more flexibility. But at the same time, it begs the question: shouldn't they be doing something with it?
I guess that's up to management, really. It's management's decision and how good at management. And it seems
capital allocation is very hard skill, and even some of the biggest companies struggle with it. So I suppose if they can't find an opportunity, then I suppose it's better they don't throw it down the toilet on something.
And just give it back to shareholders.
Yeah.
If you've got cash there and you don't think you can do more with it, then you should just give it back to shareholders. Goes back to, well, what's your view on management? I think management is something we think is important. It depends really on which stage. I was watching a video yesterday actually on Aswath Damodaran, who's the godfather of valuation, and he was talking about, which is at different stages of a company, you need certain types of sort of leaders. So at the earlier stage, it's much more about narratives and your ability to sell a vision and a story. And then as you become sort of more mature, you want to have the ability to, it's more about the financials and the finances. So you want probably a different sort of level CEO who's probably focusing more on optimization. But then that in itself becomes the dangerous part of that business, because there's no innovation, because you become old. It's just how a company ages. So in your opinion, what's your sort of view on management here? Is there a sort of founder who's still a manager here, or part of the management team, or is it led by ex-Harvard Business School MBAs running the company?
So at the moment, the CEO and chairman is a chap called Joe Kiani, and he is the original founder of the business. He's still there, cracking on. And like we mentioned earlier, the company's been around for a while. It was founded in 1989 as a garage startup, and the goal and objective was to solve the problem of inaccuracies from medical devices. Specifically the ones surrounding patient monitoring, which is how this business makes money. And I think it's fair to say he succeeded. I mean, Masimo today is a multi-billion-dollar company with its steadily increasing revenue stream and cash flows. And the man himself has actually got 50 patents to his name. So I think it's fair to say he's pretty innovative.
I think that's what you want. You want a strong leader. I mean, from your opinion, just so people know, how important is it, or is it a massive factor in these 10x or 100x baggers that you have a visionary founder, or not visionary founder necessarily, but a visionary CEO, visionary founder slash CEO?
So I think it's vital to have someone that has an idea of what they're aiming for or what problem they're trying to solve. Because if they're just trying to be another version of something that already exists, I mean, that can work to some extent, but it's not necessarily going to land you in the 10 to 100x territory. Now, the exception in the case of Masimo, because it's effectively what they're doing, their technology is significantly superior to conventional monitoring devices. That's how the group has managed to sort of carve out a stake within a highly competitive field, even with all the barriers to entry created by FDA approvals and requirements.
Okay.
So, yeah, I would say it's quite important. But at the same time, you've got to be realistic. You can have a lot of bold statements being made. I know Elon Musk, for example, he likes to make a lot of promises, but if you track the progress, quite a few of them fail to materialize.
Yeah, no, I
in
think
the long term, maybe that will happen, but for now, he's not the only one, mind. There's plenty. It's good to aim for the moon because you've got to think in the future. But at the same time, you've got to be realistic with your expectations, and it can often lead to investors potentially getting overexcited when it comes to the valuation.
And I think you've got to aim for the moon in the sense that you've also got to be, like you say, realistic, cognizant of the cash that it's going to require to do that. Sometimes when you hear Elon Musk, I think someone asked him a question of, "Oh, are you going to have cars that sort of drive underwater?" And he says, "Well, I'm sure one of the models it could be possible on that, but I don't see to be a great demand for it." So you can tell he's definitely got commercial savvy, right? He's not just doing far-fetched ideas. He's looking at things where there's going to be real opportunities from a commercial perspective. And I think that's the element, is how can you think commercially about an opportunity? Great. I mean, look, I think we've covered quite a lot of ground here, but I mean, we haven't really talked about the competitors and what the competitive landscape is. So from your perspective and the research you've done, what are the competitive advantages of Masimo?
Okay, so we've sort of already touched on this a little bit, but we'll go in a bit more detail. Obviously, the most obvious one is the barriers to entry created by the regulatory environment surrounding healthcare. Even with medical devices, you can't bring them and start selling them to hospitals or even individuals, legally anyway, without approval from regulators. So in America, you've got the FDA, here in the UK, you've got the MHRA. So that automatically, because of the giant capital cost requirements that comes with getting a product approved by regulators, it's very unlikely that the startup is going to come out of nowhere and disrupt the entire industry. So that adds a nice little buffer to start with. But the real advantage comes from a technological edge. So we were talking just a moment ago about trying to solve the problems with conventional pulse oximetry devices. This is the stuff that sits in your finger and measures your oxygen levels. And the way most of these devices work, including Masimo's, is there's a little, okay, we won't go too deep into the science here, but you've got two light emitting diodes, and that's essentially sending infrared light through your finger or through whichever extremity you're currently measuring from. And there's a photodetector on the other side, and it's essentially measuring the level of light absorption. From that, you can determine all the stuff going on in your blood. Voodoo science. So Masimo, what they do is they take it one step further and they apply some signal processing algorithms which are proprietary. And through those algorithms, they can eliminate a lot of false alarms. Currently, with conventional methods, around 70% of the oxygen warning alarms that go off in hospitals outside of the operating theatre are false positives. And the reason for this is the traditional methods, the slightest movement of a hand is enough to send like the wrong signals and outliers, and suddenly you'll have medical staff running into a room and realizing everything's completely fine. So yeah, by essentially taking it one step further and doing all the signal processing, they can eliminate all of that. And at the same time, they can extract the additional information. We said at the start, it's not just oxygen levels, it's checking stuff like carbon monoxide, hemoglobin. It's a lot more accurate compared to a traditional route. But at the same time, it's more expensive. So if a hospital is willing to pay extra for this higher accuracy device, which is less likely to waste medical staff's time, that itself also leans towards a bit of pricing power.
Okay, so you mentioned a slight setback on a disadvantage or a threat. Is there anything else that you think is a potential sort of threat to the company or concern that we need to be aware of?
Okay, so again, we talked about this briefly. They've got the over-reliance on the GPOs. That is somewhat concerning, but it's also quite common within this space. I mean, that's just how you deal with hospitals in America. So, you know, there's only so much that we can talk about that. But another threat, the medical devices aren't cheap. When you're a hospital and your budget's already pretty strapped, and someone comes along saying, "Look, we have a method of monitoring patients' oxygen levels, and it'll only cost you 3 or 4 times more than a traditional route," it can sometimes be a hard sell. So the company really needs to demonstrate why its technology is better and how it can end up actually saving hospitals money in the long run. If
Okay.
the company, for whatever reason, can't do that, right? The sales team is inadequate, then suddenly competitors will start coming in, they'll begin losing their market share. And then if it comes to a stage where they're removed from one of the order contracts of a GPO, it can be exceptionally difficult to get back on those lists.
Yeah. Okay. So it's definitely something to be concerned about. Um, I guess taking into all these factors and points, what you've done some work on valuations and what the stock price you think is worth. So why don't you give us a bit more information on the valuations, and I guess people can see in the premium note a bit more about the assumptions you've made, etc. So you can see that in the description below. But why don't you just give us a quick overview of what you thought the valuations were?
Okay, so at no point in this stock's history, unless you go back really early on, did it look cheap. I mean, even today, after the share price has basically halved, it's still trading at 37 times earnings. It's quite a lofty valuation from a multiples perspective. For the premium report, we did a discounted cash flow model, and like I said, all the assumptions and how that was laid out is in the report, which is in the description. But it was a bit of a tricky one to do because they're doing the giant merger with Sound United, and Sound United being a private company, there's very limited information on it. It's not like public where they'd have
Yeah.
to disclose everything. Private, they only have to say so much. So we were able to track down an estimate of their revenue figures, which came in at about $200 million. So we assumed that would remain flat, which in reality it probably won't. So it's quite a conservative assumption to make, but because
Yep.
we don't know much, it sort of adds in a bit of a margin of safety if you want to go
Yep.
the Warren Buffett route. But putting it all together, we found that even before the crash from this year, the stock
Yep.
was definitely overvalued. But now that the crash has happened, our models suggest that investors may have overreacted slightly, and the shares are currently trading at a slight discount to where we think the intrinsic value should be.
It's an interesting one because the more I think we can discuss this in other episodes, and I think we can even do a whole talk on it. Is price is what you pay, value is what you get.
Yeah.
And I think you mentioned that this is quite expensive, but actually you sometimes want to buy if you buy great businesses at fair values, which is what Warren Buffett's model is now,
Yeah.
then you're onto a winner there. And that's kind of what we're looking at. Is a business you think is going to continue to generate cash flow and be cash generative, it gives it a lot of optionality to do a lot more with that cash in the future, which would arguably increase earnings per share momentum, which is a big driver for share
Yeah.
price movement. So it's one of those things where you look at this business, it's cash generative, and you're putting everything in perspective. I mean, these are some of the factors that we put into a Cog Score. So we look at
Yeah.
the Cog Score as a big factor of what is a good or bad investment according to our opinion. I know we're not going to read it here because we'd rather people go on the website and have a look, and you can see in the description below. But do you want to give a bit more on what gave this a higher weighting in the Cog Score, based on certain factors that we've discussed, and what might have detracted from it, just so people get an idea of what this Cog Score is really all about?
Okay, so we've already, like you mentioned, the Cog Score is a reflection of what we believe the company is in terms of its qualities and whatnot. And a lot of the points that goes into it is derived surrounding the company's state of cash flows. And if we ignore the giant acquisition, Masimo's cash flows have been quite impressive. It's a highly profitable business. and it's one that is able to essentially reinvest in itself. It doesn't necessarily have to go out and get external funding. The level of debt, it's going up because of acquisition. Let's ignore that for a moment. But until now, the level of debt hasn't really remained that high. And it's the same with the shares outstanding. They haven't been buying back shares, but the number of shares going outstanding hasn't been increasing very quickly either. So when you have a highly cash generative business, that automatically starts leaning itself towards a higher score. Now, what brought it down is some of the concerns we've already discussed. There's some, despite having this a solid sort of financial standing, there's some significant weak points scattered throughout this business, which there's no real easy fix to them. So it's going to remain a prominent threat, 5-6 years from now.
It makes sense. I think that's a fair, valued approach. I think, or people can read the full note if they want to, and in the description below, and really get an idea of what your opinions were on this stock. And for those that want to see more of these videos, we encourage you to subscribe to our channel, where we're going to be doing a lot more educational videos as well. We'll be talking a bit more about valuations, and also sharing our investor guide, which is coming soon as well. So if you go into our website, you can get access to that. Next week we'll be looking at Hewlett Packard, which is an interesting one. It's it does, as everyone knows, notebooks, laptops, desktops, and printers. So it'd be interesting to see what our opinion is of that. So stay tuned next week for that episode. Thank you very much, Zaven.
Thank you, Imran.